What is up, guys? This is Kip, and today I'm going to start a free YouTube series here to go through my entire trading methodology and how to put all of the pieces of it together in order to execute high win rate trades consistently. Personally, I haven't really seen much of this type of TA out there on X or YouTube or from other groups, so it might be new to you as well. This will take about 30 or 40 videos, so make sure to subscribe so you don't miss any of these over the coming weeks and months. Without further ado, let's get into it. The way that I look at the charts to analyze price action and determine my trade setups, it's based on a mentality that every single move of the market is an investment and every investment has a target. My methodology for analyzing price action is about capturing what the different investments of the market are and then determining where these investments would likely take profit. It's a quantitative approach that is logical, objective, and it gives me reasoning and bias for why things are happening and how to interpret them. There are different types of investments made in the market on every time frame. The more that we can understand what these different types of investments are, the better that we can get at predicting reversal areas. We all have our own go-to methodology that makes the most sense for our brains and our unique personalities. Let's say that Jeff is trader type A. Based on his methodology, Jeff feels confident about a level holding as support. But if trader types B, C, and D are all waiting for a different level, then in theory, it may be more likely for price to have a reaction in the area where a higher percentage of trader types are in agreement with. This helps us refine our own system and find confluence for our trades based on how several different methodologies can line up together. Everybody's system is different, so let's throw out all the infinite possibilities and agree that we can't predict where every single trader will want to get in or out of their trades. With that being said, let's assume the next several points for simplicity. Professional and institutional traders consider a successful trade and will take profit when their reward to risk ratios have reached 1-to-1, 2-to-1, or 3-to-1 levels. They don't hold on to a trade to the moon nor to the dumpster fire. They're typically trading with some type of system based on a reward to risk ratio and win rate. This may especially be true for institutional traders who would have a fiduciary responsibility to their investors to take predetermined profits based on their risk. And since these institutions trade with much more capital than individual traders, the profit targets from their investments are much more likely to be creating pivot points in the market. Also, since they need more time to fill up these larger positions, they don't catch perfect tops or bottoms, nor do they care to. They have to fill positions across some type of move or range in price action over some period of time. Thus, their reward to risk ratio would be reflected across that whole move or range. So with this concept understood, my approach to trading is about analyzing and capturing what these different investments are, and then lining up the areas where all of those reward to risk ratio targets would be. These would be the zones where I look for pivots to get put in and where I would look to counter trend. In the coming videos, I'll be starting simple and then getting more advanced as we go. There's a lot of different ways that we can approach how to objectively look at a piece of price action and determine how to capture that as an investment. We need to understand several different methods, how to combine them on different time frames, and then how to actually execute our trades based off of them. So that wraps it up for the intro. Now let's get into the first go-to method of mine that above all I trust the most when it comes to accurately capturing the investment for a move in the market, and that's called the scalp pull. The theory behind the pull is that when larger traders have conviction for a reversal in the market, they're absorbing counter trend positions via limit. Personally, I do believe that a lot of these scalp pull reactions are algo driven. Since larger traders need to fill large positions, they can't worry about catching a perfect bottom or top, nor do they care to. And they don't want to move the market before their positions are filled. So they take their time to gradually build their positions until the market is ready to reverse. Once the reversal begins, we start using that pull as a bias for how far that current move could go. It's just as useful for formulating bias as it is for predicting reversal zones, and it can be critical for helping us execute our trades. We'll grab our fib retracement tool and select our pre-saved template, and then drag it from the low to the previous pivot high. Now we've captured this investment and have our levels of support and resistance. The reason that we're only interested in the lower high here and not the overall high is that we're assuming that these larger traders investing into that move would not start investing right at the tip top. We're assuming that they are savvy traders who are waiting for a reaction and a retrace first and only then start investing into the move. The lower high will always take priority over the overall high because of this. The most important fib levels that we want to be concerned with here are the 5-4 retracement, the -3-4 extension, and the -1 extension. The overall target of this type of investment is the -1 extension. This is where we assume that price will try to go. Now, sometimes price doesn't have enough strength to make it all the way to the -1. And that's why we also use the -618, 706, and 832 levels. From my experience, the 706 and the 832 are the more reliable of the three. Price rarely just finishes at the 618. So now that we know how to pull it, let's talk about how it can help us. There's a few common interactions that price has with our fib levels here. Most often, this pull goes hand in hand with a local market structure break of the previous high in which we pulled the fibs to, and then price will start to get a reaction from the -3-4 extension. The first setup that we would want to look for in this scenario is the 382 to 54 retracement from our pull. This is what we'll refer to as the kickback zone, and where we expect the bulls who invested into that move to support the continuation of that move to their targets. If price respected the 3-4, we'd want to see equal respect of the kickback zone to feel confident that there will be continuation up to the 1. This is an all-day, everyday type of setup, and the exact type of thing that we'd look for on a lower time frame once price has reached a zone of interest of ours. This pull is great for extra confirmation on our entries. If we're looking at our example alone, this is a situation where we would look for the same exact type of setup on a lower time frame as it's approaching our higher time frame kickback zone. Reaction, market structure break into 3-4 extension, retrace into kickback, and then enter. So you can see how we can extrapolate the same exact theory onto lower time frames. Using our higher time frame bias as our guide, we can execute our trades on lower time frames in order to get more confirmation and a tighter invalidation. Let's get back to our base pull and discuss the common variations that we expect price to make between our fib levels. So to recap again, scenario number 1 and the most common and ideal interaction is a simple 3-4 extension, retrace to kickback, and then continuation to -1. Every once in a while, price will overshoot the 1, and that's why I have the 1, 2, 3, 6 on there. We can look at the 1, 2, 3, 6 as the final stop. I'll keep it off for now, but just be aware of it. As I've said, sometimes price doesn't make it all the way to the -1, and that's why we want to make sure to monitor the 706 and the 832 levels especially, because they're the most common levels for price to stop at, especially if price did not reload at the kickback. Generally speaking, a reload at kickback will make the move stronger and thus increase the probability for price to make it to the -1. A second scenario is if price is extremely impulsive, it might only give a small reaction at the 3-4, and then instead of retracing all the way down to kickback, all it does is consolidate between the 3-4 and the 1-7-8 before another move up. In this case, if you have other confluence in analysis showing that the current move up could be a strong one, then you can take a trade setup right here off the 1-7-8. As long as the 1-7-8 is being respected, you can look for a low time frame setup. A third interaction we see price interacting with this pull is a front run of the golden pocket. We can look for two different setups here. One would be a backtest of the 1-7-8 or 3-4, preference to the 1-7-8 because it's a little bit deeper. The other case would be a golden pocket front run and then coming all the way back down to kickback, in which case we would look for the same exact setup as scenario number 1. So we can see how this pull can be a great way to start helping us with our bias. Say that whatever time frame that we're looking at, we're in a situation that we have a good pull, we're respecting the 3-4, and now price is coming back down to kickback. We know that we can't get too bearish here because until kickback is disrespected, we would be looking at as support before another leg up. Now let's talk about the scenario where kickback does not hold. If kickback is disrespected, we just scrap the pull. It doesn't mean that it was a bad pull or that it was wrong. It's just giving you a heads up that a higher time frame move could be in play. So let's switch to a higher time frame and see if there's something bigger that could be happening. Now another scenario is if it disrespects it but then continues to range without taking the low, that could just tell you that a higher time frame accumulation could be starting to build here, in which case you just wait for more data. Another heads up that a higher time frame move could be in play is if there's no respect of the 3-4. In this case, we could keep our same pull here that we've been looking at, but just wait to see if there's reactions at the golden pocket levels up to the -1. If there's no reaction, then we switch to a higher time frame and see if there's a different pull that could be in play. I'll finish this up with a couple different situations that are more rare, but I want you to be aware of them. Generally speaking, the -1 is the target. So if price stops at our -1 from our respected pull, we can consider that move being finished. But, and especially if the kickback was not reloaded at previously, the kickback can still be a great place to get a scalp from. And every once in a while, that can even turn into a significant pivot for a higher time frame move for continuation. One last scenario is when we respect the 3-4, but then shoot past the golden pocket and the -1 like butter. In this particular case, we can actually look for extended targets of this pull. That's the 1706, 1832, the 2, or as the final stop, the 2236. In the next video, I'll cover several examples of all of these common reactions that I've covered here today on the actual charts. I'll discuss how to find the right pivots, prioritizing respect and momentum. I'll use several different assets across different timeframes, and I'll throw in some live traded examples that I've saved up as well. All right, guys, that will wrap it up for the intro to the methodology and Scalp Fibs Part 1. Make sure to give us a like here if you like this, and hit the subscribe button with the bell notification just to make sure that you don't miss any of these videos in the coming weeks and months. Thank you guys for watching. I appreciate you guys, and until next time, I'll see you in the next one. Bye.